Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P, the QQQ, and most of your major sectors having a very big green day. It seems as though even the thought of September seasonality is not enough to keep the markets down and out. The raging bull market continues to push on higher, the S&P almost closing at brand new all-time highs, and the Qs, although slightly lagging behind, not looking too bad, pretty much engulfing all of the early September weakness that we saw start on the Tuesday session. Now, we know that market breadth overall has been fairly good, and we haven't really found many days recently whereby every single major sector of the market has been down. You've always been able to find some rotation, and the market breadth does indeed still show that as well. The percentage of stocks above their 20-day moving average is still at a very healthy 61%, despite coming down off of the highs of 2 weeks ago. The percentage of stocks above their 50-day moving average still above 62%. Anything above 50 still does show that institutions are net buyers in this market, and the percentage of stocks above their 200-day moving average, arguably the more important one of all of those metrics, still stands at a very cool 60%, showing that much more of the market is participating to the upside than was previously established either in the lows of August or even back in the months of June and May as well. The highest reads, once again, that you've pretty much had all year. You'd have to go back pretty much to last December to find such bullish momentum all across the board. As a result, you are finding some rotations in and out of tech, then into value, then back into tech, and there's always something that is holding up the markets. Today, it was a question of the broad market bulls taking control, and there was a few reasons for that early this morning with some macro data releases. Number one, of course, we have to talk about the jobless claims. That came in barely higher than the expectations, and it continues to be a market environment pertaining to the jobs market where it's a no hiring, but also a no firing economy. We know that there's still a lot of jobs available in the economy, 7.2 million jobs to be specific. We also know that the unemployment rate is at historical lows. It currently stands at 4.2%. We're getting the updated read tomorrow. The consensus is for 4.3, but both of those numbers would still point to 10-year historical average lows. Now, another piece of data that came out this morning is the non-farm productivity, coming in at 3.3% versus the 2.4% expected. So apparently, even though that we are creating less and less jobs in the economy, which is one of the current worries of the Federal Reserve, apparently employees are getting more productive in the process, which may forego the need to have the full employment that, well, I mean, we are at full employment, right? But just filling the rest of all the jobs for people who are currently seeking employment. And then, of course, was the big one here, guys. ADP employment change. This was coming in at 54,000 net new additions to the private sector as opposed to 65,000. Now you might be thinking, well, the jobs number came in light. Why are the markets higher? Well, this is a case of like a Goldilocks scenario, right? Whereby bad news is kind of good news as long as the bad news is not too bad. If you really see a negative jobs print, meaning that we lost jobs, or this number coming in way, way, way below the estimates, then that would obviously put a point in the favor of the bear thesis that the economy is slowing down and that the jobs market is unraveling faster than people are anticipating. This did not show that today. If anything, it solidified the rate cuts for the month of September and possibly even pushing the Federal Reserve to having to cut rates on an accelerated path, which is why a lot of your yields came down really fast and really hard over the course of the day today. Now people potentially pricing in a 50 basis point cut for either the September meeting or maybe even the December meeting. So we'll get to hear from the Federal Reserve in the mid-September meeting coming up September 17th, but tomorrow's non-farm payrolls is your last volatility catalyst for the week in terms of the jobs data. And I think it's largely going to be the same. If this one comes in slightly under the estimates, but not too bearish, you might see a similar reaction, whereby this once again will put a point in the favor of the Federal Reserve accelerating the path of rate cuts just to kind of get ahead of any meaningful economic damage that could be the result of the jobs market unraveling at a faster pace than they had prior anticipated. So as a result, right now, guys, we stand in an environment where bad news is good news as long as the bad news isn't way too bad, right? I know it's a bit of a tricky one, but we had this same exact scenario all the way back in 2024. In terms of inflation, well, the Fed already told us a few weeks ago when Jerome Powell spoke at Jackson Hole that he believed that inflation was largely, to use the T word, transitory. It would be one-time effects from the tariffs overall. If you take a look at your Trueflation gauge, we are currently still at about 2%. This one measures over 15 million different products, 30 million different data points amongst those products, and as a result, can be interpreted to be more reliable than the CPI, than the PCE as well. So this is the gauge that I'm looking at, and apparently right now, inflation is just not that much of a problem for the markets. So as a result, you come into a situation like this, whereby the bears have a very decent thesis. It's the economic unwinding, possibly leading into a recession as a result of the tariffs, which will impact consumer discretionary spending, and the loss of jobs, which will also impact consumer discretionary spending, and as a result will impact company earnings and corporate profits too, bringing down EPS estimates, and in the process, bringing down the markets. But we are just not seeing that already, right? All of the data points so far are relatively good. The productivity numbers are good. The GDP numbers that we got just last week are good. The jobs market is slowing down in terms of net new additions to the jobs market, but we're not seeing mass layoffs, right? So that's factor number one that you have to keep in mind if ever you're looking for a recession. Are there massive layoffs? No, we just heard from Q2 corporate earnings, 80% of all companies reported positive revenue beats, and 80% of those same companies reported positive EPS beats, and a lot of companies reiterated or raised their year-end guidance. So as a result, the economy is strong, the jobs market is not too bad, inflation's not a problem. As a result, it's very tough to build a long-standing bear thesis that we are currently on a precipice for a massive bear market or a massive recession. Now, of course, the environment is still cloudy and we do still have to be a little bit cautious, but you guys know my stance. I haven't wound down any of my very long-term bets on the market, especially talking about the leap call options. We know that recently, since the end of the month of July, it's been a bit tricky in terms of short-term swing trades because some of your market leaders, such as semiconductors, have turned into slight bears or even sideways action, and a lot of the growth names that powered the runs of May, June, and July, the Robinhoods, the SOFIs, the Palantirs, they've also kind of just been stuck around similar levels recently, so you're not seeing too much momentum in a lot of the same growth names that had that momentum a few months ago. So some of the swing trades have been challenging, but the long-term thesis for a lot of these companies is very clear. Good earnings, good revenue, no massive layoffs, the economy is strong, inflation is still low. So as a result, it's very difficult to have a longer term or even a medium term bearish thesis on the markets. So that's a very brief introduction for today's video and why the markets were green today and why you might just expect the same thing in the event that the non-farm payrolls tomorrow come in slightly under the estimate. If they come in way too bearish, then of course the markets are not going to like that because that puts a point in the bears camp to where, well, maybe the jobs are unraveling at a faster pace than expected. But if everything stays relatively smooth, I would expect a kind of similar day as today. So that is your kind of pre-market prep for tomorrow. Now, in terms of today's video, what we're going to do is a few key things. Number one, we are going to cover two company earnings that had their earnings after the bell today. We're going to be taking a look at Broadcom, which really had great earnings, and LuluLemon, which really did not. So we were going to do those two companies in just a few short moments. After we're done with that, we'll take a look at your major market rundown in terms of technical analysis on our major market sectors, see where the rotation is, see where the most favorable positioning can be as well. Thereafter, we will do the same thing across our big tech list right here, derive which of these companies is currently in very nice areas for some swing trades or some long-term positions. Thereafter, at the end of the video, I'll take you guys through the biggest gainers and losers of the day, of which there were many, especially to the downside. But not only that, even to the upside, some very interesting names coming back from some of their previous declines earlier this week. So we'll have a look at that section at the end of the video. And that's going to be it for today, guys. This is going to be my last video of the week because tomorrow I'm going to be traveling. So coming back to the travel schedule, I'll be gone for roughly 4 to 5 weeks, but you guys know the drill, right? Still going to do the Sunday top 5 options videos, still going to be here Monday through Thursday, but no more Friday or Saturday videos. That'll be my time to kind of enjoy the holidays, but everything else will largely stay the same. I'll still be here with you guys every step of the way and recapping the markets on a daily basis, except for the Fridays. So thank you very much for understanding. Without further ado, let's get into today's action, shall we? So the SPY up 0.84, the Qs up 0.91, rotation very healthy today. You remember yesterday, it was only a couple big tech names holding up the market, namely Apple and Google. Everything else was kind of just muted. Well, today, everybody showed up to play, right? Financial showed up to play. Healthcare showed up to play. The bottom half of the market, interest rate sensitive sectors showed up to play because yields were down in a big way. And most of all of your big tech names coming back in a very decent fashion. Shout out to Amazon, up 4.3% after two pieces of news, which we will get into when we cover Amazon's chart in the later part of the video. Very nice movement there on Amazon. In terms of the one-day relative, this looks very different than it did every single day this week. Every single other day this week, you were noticing a mixed bag, right? Half the market was up, or maybe a third of the market was up, and then everything else was down. Today, very nice broad market push. Anything from cyclicals all the way down to healthcare were notably higher. Very nice there. And on the 1 week relative performance, after a choppy start to the month of September, which saw some pretty decent declines on the Friday and then into the Monday session, we've now recaptured a lot of that. So on the 1 week relative, communication services is your best performer. Of course, that has to do with Google, Google's gains yesterday, Meta, and even Netflix continuously pushing higher right now. So communication services is your best performer, followed closely, well, not closely, but followed second by consumer cyclicals, financials, defensives, and healthcare. Technology still a little bit flat. And a lot of that has to do with the somewhat lackluster performance of the semiconductor industry. NVIDIA still down meaningfully from its earnings release. So before we get into more technical analysis, guys, let us dive into our earnings presentations. And we're going to start off with the biggest one of the bunch, or the biggest one of the two, because we only got two today, Broadcom. So Broadcom up right now 4% after their earnings. They absolutely crushed it. Now, keep in mind, coming into this earnings, there was a lot of pressure, kind of like NVIDIA as well. Why? Well, because this company is already up 30% year to date and had a phenomenal rally from the bottoms of the April sell-off all the way to the top, 125%. So kind of like NVIDIA and other semiconductor names, there was a lot of pressure. Do they deserve the sheer size of this rally? Can they keep posting good enough numbers to keep their valuation a little bit elevated? Well, at least so far, the answer was yes. Beat on EPS here by about 1.69%, and they did beat on revenue by 0.8% overall. Not the largest beats on the current quarter, but they did provide very, very solid guidance. If you take a look at some of the easy guidance numbers, you'll see that Q3 sales, they guided higher, 17.4 billion versus the 17 billion estimate, and EBITDA as well, 11.7 versus the 11.2 estimate. So next quarter's guidance, very good, and the full year-end guidance as well, extremely strong from Broadcom. If you take a look at more easy numbers right here, I will gladly move myself to the side. Revenue was up 22% year over year. Earnings were up 36% year over year. Their semiconductor revenue business, 26% year over year. Their infrastructure business, 43% year over year. Extremely strong gains all across the board for Broadcom. Nothing bad to say. And look at this operating and net income boost right here. Operating income up 55% year over year. Fantastic. And Broadcom posting very attractive net margins here of about 25.9%. Extremely juicy margins, very nice revenue gains. So we'll move into a bit more of their earnings and see a bit of the breakdown as to how they made that possible. So here you go. Broadcom reports a 63% jump in AI revenue as the results beat estimates. Now, if you guys are not too familiar with Broadcom, I know it's one of the ones that gets talked about the least, but Broadcom is a very broad, no pun intended, company, guys. They have a very broad IP portfolio with over 20,000 different patents. The number of things that they do is quite staggering. Their business is broken down in two very simple things: infrastructure software, because they do a lot of software plays, and then semiconductor solutions, which does encompass their data center ramp, namely in their AI XPU chips and AI networking. And then that's where also you have the server storage, industrial, their broadband connection as well. And they just do absolutely everything, guys. You can see here, broadband end-to-end solutions, industrial solutions, automation, renewables, and automotives, right? They do everything here. Networking, either for enterprise, data centers, or for ISPs, service providers, of course, servers and storage connectivity, wireless as well in terms of smartphones and other devices. They also do cybersecurity as part of their software division, and enterprise software, digital transformation, and enterprise. Look at all of this stuff, guys. Right? Automation, API management, application development, mainframe software as well for all your server purposes, enterprise servers, and they even do private cloud, guys. Huge, huge company, very broad company, so a bit more diversified than your NVIDIAs or your AMDs or things of that nature. So when all of their lines of business perform very well, they put up numbers like that. Fantastic beat across the board for Broadcom overall. Now, the stock rose in extended hours after the company said it had secured another $10 billion in orders from a new client for custom chips. Talking, of course, about the ASICs chips, which currently are under contract by a few big players such as Amazon, Meta, and Google, which are trying to manufacture their own chips. Now, these chips serve slightly different purposes than the ones that NVIDIA does, and I wouldn't say they are in direct competition, but still, right, there is a bit of an aspect of competition there. They serve slightly different purposes, but at the end of the day, right, the fact that Google, Amazon, and Meta want to make their own custom chips does make them slightly less reliant on only having NVIDIA products out there. But all in all, there's enough total addressable market out there for anybody, in my opinion. Company's net income, as we said, $4.14 billion, which is 25.9% net margins, very strong. Broadcom develops custom chips for Google and other cloud companies, in addition to networking parts and software needed to tie thousands of AI chips together. So a full solution overall. Now, in terms of their clients, guys, they did not name who the new $10 billion client was, but you can assume that it's probably one of the hyperscalers, a new client. So perhaps Microsoft or something like that, right? It's either between between Amazon, Meta, Microsoft, and then, of course, you're going to have Google there as well, right? So there you go. Now, moving on further, investors are optimistic that the company's custom chips may, in the coming years, threaten NVIDIA's dominant market share in AI chips. In March, Broadcom CEO Hock Tan said the company was developing new AI chips with 3 large cloud customers and said he expects the company's AI growth to continue through next year. Here's what he said: "We will ship pretty strongly beginning 2026. The Tan attributed the company's third quarter revenue growth to its custom AI accelerators, networking parts, and its VMware software. VMware, guys, putting up very, very strong numbers right here. I'm not too sure if the VMware is reported right here. Yeah, VMware revenue, guys, was up 17% year over year. I'll remind you, they acquired this company a few years ago for about $69 billion. And at the time, a lot of people were criticizing Broadcom to say, well, is it worth it? You guys paid a lot of money for this company. And you can see Broadcom has traditionally acquired its way to the size that it is today, right? It acquired several different businesses, but VMware was by far its largest acquisition of them all back in 2023. So far, so good for the company. It has really done wonders in contributing to their software growth. If we take a look at this chart right here, the blue line is their semiconductor solutions revenue. That's been having a very nice uptick over the last 3 years as they continue being a big player in the data center rollout trade. But then again, their infrastructure software solutions, look, 2023, this is before VMware. Now look, since VMware, guys, big numbers being posted here to the upside in their whole software division. That's largely thanks to their acquisition. The company said its chip sales, reported as semiconductor solutions, rose 57%. Extremely strong numbers by Broadcom. Nothing bad to say at all. If you take a look at just a few more of their slides, we don't have too much more to do on Broadcom right here, but I figured I should show you just a couple more net revenue increases, right? Look at this revenue. Now, I know it says fiscal year 2024, but that's just because they run a different fiscal year. They're in the same calendar year. I promise. These are the earnings from September 2025, right? So don't worry about that. But as you can see right here, net revenue, clear jump, gross margins, protecting gross margins, bringing more in terms of operating margins, and also in terms of net margins. Very solid numbers by Broadcom, 76.5%. In terms of adjusted EBITDA, that is also very strong, $32 billion. Clear increase, and a increase in orders of magnitude higher than what we were seeing in the previous 4 years prior to that. And free cash flow, they are still increasing their free cash flow, but the market cap of the company has ran a lot recently. As a result, their free cash yield is still about 1.3%, but it's nice to see them do that. And what are they doing with the free cash flow? Well, they're not buying back any shares just yet, but they are starting to pay down this debt. They paid this amount, right, in acquiring VMware. So that's what you want to see. You want to see this company progressively start to buy back some of this debt that it used to acquire a company that's really an accretive business to this company's revenue portfolio right now. So as you can see, free cash flow is fairly decent. Cash on the balance sheet is fairly decent, but they are using a lot of the free cash flow that they generate to pay down the debt and not so much buy back shares anymore. So hopefully that makes sense. All in all, guys, fantastic report from Broadcom. Clear gains in the semiconductor aspect of the company, so the hardware aspects of the business, and clear gains in the software aspect of the business as well. However, now at 318, the new all-time high, or just quite almost, right, fractionally above the 13th of August top right there, At 318, is Broadcom still a buy in spite of how much it's rallied without much pullback at all the way up here at $1.44 trillion? Good question. Let's have a look at the valuation, shall we? So 315, right? If we're looking at 315, the forward price to earnings is 47.3. Now, keep in mind, the company is growing EPS and revenue at very attractive clips, 15% per year through 2027 on average, and 22% gains on EPS on average through 2027 as well. Gives them a forward price to earnings multiple of 47.3 on the higher end. When you divide that by their EPS growth rate, you get a PEG ratio of 2.14. So not one of the cheapest players in semiconductors. Matter of fact, it does make them one of the more expensive ones in terms of what you are paying for the growth. I'll remind you, we did NVIDIA just a few short weeks ago. At 175, NVIDIA was a 1.71. A player like AMD, you might ask, is sitting here at about 1.46 or slightly under. A player like Micron is sitting down here at a 0.53. Now, I'm not saying all these companies have the same business model as Broadcom. Of course they don't. But just to tell you guys, in terms of comparing different companies with a common denominator, which is the PEG ratio, they are one of the more expensive companies right now in the semiconductor landscape. And the free cash flow yield, as we said, 1.3%. So the company right now is not extremely expensive, but I do think that there are more attractive opportunities in the market right now to start new positions. That being said, if we are holding any shares previously acquired through this year or years prior, I still do not see any reason to sell. The company is still firing on all cylinders. The CEO gave very good guidance for not only the end of this year, but also through 2026. Demand is through the roof for a lot of their products, especially their semiconductor solutions. They are locking in bigger and bigger clients, as you saw with the new $10 billion deal. And as Google, Meta, Amazon, and other hyperscalers scale out their own custom chips, Broadcom will definitely be the place to be for the next 2 years in terms of that type of offering. Taking a look at EPS growth right here, fantastic. They'll be doubling almost from 2025 through 2028, 2029. And in terms of the revenue, kind of the same concept, right? Not quite a double from 25 to 2028, but probably by 2029, it will be a double. So everything moving in the right direction for the company, highly profitable company. But as I said, maybe not the cheapest bet in the market right now. So this one, as of right now, remains a hold from me. It's not a buy, it's not a sell, just because there's nothing to sell it for. I mean, there's no reason to sell it, right? There's also better companies, in my opinion, to buy for faster upside. So as a result, it is just a hold. Hopefully you guys enjoyed the Broadcom earnings breakdown. Now, if we move into company number 2, this one is a little bit of a tricky one. Now, a lot of people in the past 3 weeks, month and a half have asked me, hey, what do you think about LuluLemon? So here you go, guys. I'll give you my honest and raw thoughts, which is why you guys probably follow this channel, right? You guys probably understand what I'm about to say right now. They beat on EPS by 8.5%, but they missed on revenue by 0.5%. Now, LuluLemon, prior to today's earnings, was already down year-to-date 46%. Now, a lot more. I'll explain some of the problems with this business, right? The problems with this business is that LuluLemon used to have what you call first mover advantage. They capitalized on the new athleisure trend. They were pretty much the only player in the space. And then 2020 and 2021 was the boom years for them. Everybody was working from home, so athleisure became very popular, very trendy, and now it still is very popular and trendy, but what happened in the midst of all of that trend? Well, when a trend starts to get really hot, you start to have new entrants and new competitors, right? And as a result, LuluLemon has been losing its first mover status, and now the market is flooded with competitors who offer similar products for possibly cheaper prices, and a lot of other niche brands with online marketplaces that are sold from TikTok and Instagram marketing strategies, right? A lot of these burgeoning social media companies and just digital brands in terms of new clothing brands. So as a result, LuluLemon has steep competition, but it also has something that those brands do not, namely physical stores. So obviously those physical stores represent a higher operating cost for this business. And those two things are something, or rather two big things, that have been affecting LuluLemon's business for, I would say, the past year, year and a half. And it's why I still do believe that this company is a very tough buy, even down here at these levels. Let's go through some of the easy numbers and I'll show you what I mean. So if we take a look at LuluLemon earnings right now, they missed on revenue, as we saw. They beat on EPS. But look at revenue, guys. This used to be a company that was growing revenue in excess of 20% per year. That has now slowed down to very mid-single digits, 6% only. Earnings were actually down 2% year over year. Not the best start for LuluLemon. The LuluLemon company right now is down 15, 16%. I didn't even tell you guys. It's down 15 to 16% in the after hours. And that is in spite of already being down an absolute ton, not only this year, but from the all-time highs. At this point in time, you're looking at a decline from the highs, 65, 66% down. Is it deserving of that? Well, I'll let you be the judge. America's revenue, 1% year over year. That's how much they grew America's revenue, only 1%. If it wasn't for this big beat on China revenue right here, 25% year over year, it would have been a lot worse. Same store sales, only 1% growth. That's just not going to cut it, guys, especially when the thesis for the bears is increased competition is leading to a reduction in sales and stale brand perception. Well, that's a point for the bears right there. Operating income down 3% year over year. Operating expenses up 9%. So the expense profile is outpacing your revenue profile, and it is pressuring the margins right now. And as a result, net income is down 6% year over year with a big hit on operating cash flows right here. So those are the major takeaways. And you also have, my head's in the way again, sorry about that. You also have negative free cash flow. Unfortunately, this used to be a free cash flow positive company, but in the past 2-3 quarters, they've been struggling with that. Some of that is because of the tariffs, and we're going to get into that right now. LuluLemon shares plunge as earnings guidance falls well short of the estimates. So LuluLemon shares plunged in extended trading Thursday after the company gave a much worse than expected full year outlook. And really, it was not very good, guys. In terms of the guidance, I'll show you the guidance right here. Their fiscal revenue guidance for the end of the year was supposed to be about 11.25 billion. They've now tapered that back to about 10.95. So missing revenue guidance by a whole 3%. That matters a lot, guys, especially when your revenue numbers are already not that great. In terms of EPS, they guided down, and they guided down a lot, guys. This is like a 10% miss on EPS. 14.65 was the full year EPS guidance. Now they've guided down to 12.85. That is just not going to cut it, guys. It's a very big miss on EPS, and you can tell this company's margins are being pressured, and tariffs are responsible for that, but also brand execution is another reason for that too. So it said it expected tariffs to hit its full year profits by $240 million. There it is. Here's what the CEO had to say about all this. We are facing yet another shift today within the industry related to tariffs and the cost of doing business. However, he did not blame everything on the tariffs, which was good to see. There's a component of brand execution that he will talk about down below in the article. The increased rates and removal of the de minimis provisions have played a large part in our guidance reduction for the year. This is the fact that LuluLemon could import products in very small quantities and be exempt. That is the de minimis rule, something that Temu and Shein were using to get into the US markets. LuluLemon was using that as well, but not only them, a lot of other companies were using those exemptions. Now, net income was only $370.9 million, which is not terrible. 14.7% net margins, not that bad for a clothing brand, I will admit. But these margins right here, I'll move myself over again, sorry. These margins were improving since 2020, right? All the way up to 15, 16, 17%. They're now going in the wrong direction. So that is not what you want to see, a dwindling of margins at the same time, compared to $392 million last year. So see, even in relation to last year, less net income. Gross margin decreased by 1.1% and operating margin decreased by 2.1%. The CFO, Megan Frank, said on the call that the removal of the de minimis exemption, which excluded some smaller shipments from tariffs, will significantly affect the company, representing roughly 1.7 percentage points of the 2.2 percentage point tariff-related decline in profit expected for the year. Same-store sales in the Americas were down 4%. That's not going to help, guys. That's not tariffs. That's an execution problem. That's a brand problem, right? Here's what the CEO had to say again. My view is that it's now time to reset many of our practices related to how we develop and create the range of products that will fuel the next phase of our growth. We have seen that when we get our product right, everything else can follow. LuluLemon projects third quarter revenue will come in between 2.47 billion and 2.5. That's compared to the Wall Street estimate of 2.57. So I showed you guys the year-end estimates. They were not good, under the expectations. As a result, Q3 estimates are also not that good. The EPS estimate, as you can see, the impact of tariffs really hitting right now. 2.2 is the expected EPS. Analysts for next quarter had 2.93. Huge miss in Q3, guys, on EPS and on revenues. The McDonald's CEO said on Thursday call that he believes the company has let the product life cycles run too long, particularly in its lounge and social categories. We have become too predictable within our casual offerings and missed opportunities to create new trends. Root causes of the company's product challenges in the US. Our lounge and social product offerings have become stale and have not been resonating with guests. To regain US momentum, McDonald's said that the company plans to increase its new styles from 23% of its overall assortment to 35% next spring and improve its fast-track design capabilities. The CEO continued to say, "We are not satisfied with the results for the quarter, and we know that our brand can and will perform better than these results." So you have a twofold problem right here. Number one is, of course, tariffs and the impact on margin, of course, but you can't justify same-store sales and revenue declines and revenue slowing over the past 1.5 years only because of tariffs, right? No, it's an execution problem. As the CEO said, they became too complacent, relying on the same trend that made them a very hot brand in 2017 to 2021, and then, unfortunately, they could not set new trends anymore, and as a result, the brand is being a little bit left behind. Now, the brand will always have its diehard fans. Many people will argue that in spite of increased competition, LuluLemon products are still some of the more comfortable products in the market for their niches, in spite of the higher price tag associated with them. And that's fine, but it just goes to show, guys, when you are a fashion company, and this is why I don't invest in fashion companies directly, specifically at all, really. Like, you'll find me investing in conglomerates such as Louis Vuitton. You'll find me investing in business models such as TJX, but very rarely will you ever find me investing in one single fashion brand, because when that trend dies, and if the company cannot fully capitalize, or maybe the trend doesn't die, but maybe there's just so much competition that the company loses the identity that once made it very hot. That's exactly what's happening right here. So LuluLemon, with its struggles right now at 174, which almost is the bottom of the global pandemic, is it a buy? Down over 45% year to date, 66% from the top. You must think it's a buy right now, right? Well, look at these numbers, yeah? Revenue growth for the next couple of years is about 5.2% on average. EPS growth only 7.5%. This is no longer a fast-growing company. And one of the big problems that they're having right now, because their styles are a bit stale, they're accumulating inventory. This is what killed Nike a few years ago as well. $1.7 billion in inventory, 21% year-over-year increase. You do not want to see that if you are a fashion brand. I don't care what you sell, clothes, shoes, anything. If you see an increase in inventories, guys, what are you going to have to do? They paid full cost for this inventory. What are they going to have to do? They're going to have to do what Nike's doing. They're going to have to liquidate it, right? And liquidations mean also further margin pressures. And $1.7 billion is not a very light amount, guys. This company only makes, about $12 billion per year. So as a result, that's like 10% of revenues just sitting there in their warehouses that they're not able to sell at full price. So margin impacts will be felt over the next few quarters as well. That being said, look at the revenue graph, right? Or revenue and EPS. Fantastic EPS growth. And then what happened? All stalled, right? And now EPS growth will not be very meaningful for the next 4 years. Revenue growth, explosion, right? Explosion, 2018 through 2023. Now, very soft, very, very soft and muted revenue growth. It's still growing, but at a fraction of the pace that it once was. That gives them a forward price to earnings at 175 of 13.59. You might think, well, that's a very good deal. Well, not so much, guys. It can't get a forward 20 multiple because it's not growing in line with other companies that have 20 forward price to earnings multiples. As a result, the PEG ratio at 175 is a 1.81. This company is, on the PEG ratio basis, more expensive than NVIDIA. It's literally more expensive than NVIDIA and more expensive than many other companies in its niche. Now, you might say, well, the EPS growth is too low for us to use PEG. Can we use the price to sales? Sure, we can use price to sales. Price to sales is roughly under 2 right now, which is under the SPY, but still above the apparel category, which traditionally is between 0.8 to about 1. So it is still slightly overvalued compared to some of its industry peers. So as a result, do not get fooled by a low multiple. The multiple is low for a reason, because the growth has largely slowed. Free cash flow yield is probably the best aspect of this company at 5.6%, but I'd be curious to know, will they be able to maintain that free cash flow with the impact of tariffs and with also the piling on inventories, which might have them having to reduce essentially the margins that they're willing to take, might cut into operating profits. And as a result, you might see a reduction of free cash flow generation over the next few quarters. So LuluLemon has its problems. That being said, it is still opening stores. It opened 14 stores in Q2. But that is why, guys, these fashion brands sometimes are so tough. If you don't capitalize on the initial move, sometimes you're just left holding the bag in something that is a shadow of its former self. Now, you might be willing to give LuluLemon a chance, and I do agree that down here it might be one of the better opportunities to give it a chance. But are we expecting a V-shaped recovery like this? Probably not. It's going to be one of those longer recovery stories where you will have to trust management that they've identified that there's an execution problem, and now it becomes a very long turnaround story, such as Starbucks, right? Such as Nike, such as Disney used to be. All of these infamous recovery stories. And as we see, even when the companies identify the execution problems across the board, Starbucks did it here, right? Nike identified it recently. Well, the growth doesn't really come back instantaneously. It's a very long and drawn out recovery process. So if you guys wanted to give it a chance, you can feel free to do that. I personally will be sitting on the sidelines and just observing, wishing you guys the best of luck if ever you do try to take that chance. That's everything I had for you guys for the earnings breakdowns. Now, let's jump into some charts, shall we? So into the S&P 500, as we can see right now, guys, we never broke the line in the sand level that we've been talking about all week, which was essentially the lows of 2 Wednesdays ago. The bulls held up and now almost pushing brand new all-time highs. If you break them, the daily uptrend simply continues. We never lost the daily uptrend. The bears have had so many times to capitalize on the trend reversals, and they never have done it so far. Another attempt by the bears to set up an engulfing move and roll this market over. But unfortunately, the bear market thesis is just not strong enough. The earnings are too good, and the premise of rate cuts is just too attractive to really get these bulls off of their positions. As a result, the daily uptrends possibly looking to simply continue. If you fall back, well, you got your support that we just reacted from, of course, 639 to 634. And in the event that September actually proves to be the weak seasonal period that everybody says it's supposed to be, right? Keep in mind, these are just statistics. And whenever I present these to you guys, they're just statistics, right? Even though on average, September is a weak month since 1945, the worst one of all, it doesn't mean that every single September has to be negative. You kind of have to weigh where we stand in the market right now. What's the bull thesis? Earnings, rate cuts, things of that nature, right? And then the bear thesis. Is the jobs market going to dwindle away faster than the Fed can cut rates? Is the GDP going to fall faster than we can cut rates? Is the tariff uncertainty just too large for the markets? It's always going to be a battle of the narratives right now. And so far, the bullish narrative just currently still winning. So as a result, in the event we do get a rollover of these lows, you guys know I love giving you guys the bearish estimates because that's what everybody's worried about. You would still just be looking for another weekly higher low, anything above 619, weekly higher low, and again, the monthly too. So the monthly still pulling away, still no monthly consolidation. But if you get it, for XYZ reason, non-farm payrolls tomorrow or whatever happens next week or during the Fed meeting in about 2 weeks' time, looking for the monthly higher low, all dips, especially extended dips, still for buying on our favorite names, which is why I always give you guys the buy the dip levels, not only on individual sectors, individual big tech names as we run through every single day. And I tell you guys where I'm buying in spite of the current narratives. And also at the end of the videos, when we look at the biggest gainers and losers of the day. Moving on to the QQQs right now. So QQQs also up 0.91%, another 0.21 in the after hours because of Broadcom's very nice earnings. As a result, daily downtrends, nope, can't get it, right? They tried once with the non-farm payrolls a month ago, couldn't get the rollover. They tried it again with this candle right here with the tech scare about 2 weeks ago. They had nice retracement size, couldn't get the rollover. They tried it with the early September seasonality dip, could not get the daily downtrend rollover. The bulls just proving to be too strong. And with every one of these releases that just doesn't come out as negative as people are anticipating, it just adds another point to the bulls, right? So the bulls retain full control of these markets, as we've been saying this entire time. Until I see a daily downtrend, you are not in weekly consolidation, right? Just sideways price action right now. You're looking for the expansion beyond the highs of last Thursday. If you get it, daily uptrend is now back in the favor of the bulls. In the event you lose this area and lose short-term support, 562 to 554, that is your daily downtrend. That is your weekly consolidation, and possibly also that will be your monthly consolidation too. Good thing we have huge support below us, guys. So I'm a bull. As of right now, I have all my long-term positions, didn't sell anything in my long-term portfolio, have a bit of cash, I'm trading the markets every single day. Short-term swing trades are a little bit choppy right now. Long-term thesis on a lot of these companies is very clear, and any dips, especially extended dips on the monthly, indeed are for the infamous reload area into the end of Q3 and into Q4 if you get it over the next few weeks. Moving on to financials right now. Financials, very strong day for financials, 1.05%. This is a chart that never even came close to losing the daily, right? No huge retracement size, engulfing move like this. No, just clinical daily higher low setting of the bulls into prior resistance, current support, 12 EMA, riding the heck out of short-term bullish momentum, looking very strong. Weekly chart looking primed for some further expansion right now. Financials looking very good. And I'll remind you, even if you do get a pullback, looking for a weekly higher low, anything above 51.15, weekly higher low, and tons of prior all-time high resistance, current support for the bulls. Look at this monthly time frame, guys. It looks very nice, even on a back test. It would look fantastic for an increase here in financials into the end of the year and 2026 as we move into a rate cutting environment, which traditionally is very good for financials. Moving into XLV healthcare right now. Healthcare holding the top end of the range right here. The bears tried a couple times to flush these lows into an extension of a daily downtrend, simply not getting it done right now. The bulls are playing very good defense. You could argue this is indeed a bull flag. I like to see when the bulls put in such a very nice move, where are they consolidating? Are they consolidating all the way down here and giving back the entire move? No, they're consolidating in the top 25% of the move. Just goes to show you they want to keep the momentum alive on the higher time frames, right? Weekly nice engulfing move, shallow bull flag testing the top end of these resistance candles right here. Current support, possibly looking for that expansion leg, looking very good on healthcare. I'm still a big believer that healthcare could be one of the better trades here into the end of the year and into 2026 as it plays catch up with the S&P. Still your weakest sector across the board the entire year. Still one of your more undervalued sectors as well. Moving on to semiconductors right now. Semis coming up a little bit higher today. Not able to flush these lows. Triple bottoms into short-term support, 283 down to 276 on SMH. Yes, the price action has been very choppy, but have the bears been able to capitalize? No, they cannot get the flush underway right now. As a result, it's just been sideways consolidation above your more recent area of support, which is the tops of those candles last year in July of 2024. And as a result, we are still just looking for the break of this range one way or the other. Either give me the upside break, which means weekly consolidation is done, and you're looking for an extension here, possibly all the way up to 300 psychological on SMH. And as a result, your monthly higher lows will just be set sideways into another leg of expansion. In the event the bears take control again and drop us through support and go into actual weekly downtrends, actual monthly consolidation, beautiful area back here, 261 to 250 if you're using the SOXX. The concept is the exact same, except for the resistance, which is support right now, is a little bit closer, right? This entire roughly 5 to 7% range below us, fantastic opportunity to be picking up some of the names that are currently, in my opinion, some of the best looks for semis right now. ASML, Micron, AMD on these dips, even to a certain extent NVIDIA on these little consolidation phases right now. Not too bad at all. Moving into SMH right now, moving into the IWM Russell. Russell, 1.25% to the upside. The Russell responding very well anytime yields go down in a very big way. And this is the trade that's tied the closest into yields. So pay attention to that correlation. Beautiful daily uptrend still underway. Higher lows are set right now, 231.58, looking for the upside break of the prior highs right there and looking to challenge your actual all-time highs in around the infamous 245, which is the same place that stopped us in 2021 and also 2024. So we will see if they can get it done. Nice little backtest here of support. Looking just for the extension here of the weekly uptrend. I would not be surprised if the non-farm payrolls tomorrow is flat or slightly underwhelming. The yields are going to drop again. And as a result, the Russell is probably going to have a good day. We've been talking about the Russell, and I've been saying it's a good time to position, but this is a position trade, not 1 week call option trade. It is a trade for the next 6, 9, 12, 18 months. The expansion of the growth segment of the market that responds to further and further cuts in the interest rates, a sector that has not done anything in roughly about 4 years worth of time. That's your overall market rundown. Hopefully you enjoyed that. The VIX down again, 6.43%. Could not get it done again, guys. If these macro catalysts do not come in a lot worse than the expectation, then where's the uncertainty going to come from? It's just not going to come at all, right? So the VIX remains a very nice trade both ways. Come back to those. We're shopping for leap call options on things that have consolidated or things that are being left behind. Get a nice little pop on the VIX like we got on Tuesday, and we get an increase in volatility and very fast changes in price to the downside. Fantastic opportunity to be selling some options on that increased volatility and on very fast declines right in the market. Into yields right now, yields coming into a big area, guys. This is very big for yields. We've been talking about this one for like 5 months at this point in time. 4.2 break to the downside. Why is this important on the 10? Weekly downtrend. They're trying to go for it. Weekly downtrend. They're also trying to go for the monthly downtrend as well. It's been a while. We haven't really lost this 26 EMA in how long? 3 years. They're rolling over these time frames as we move closer and closer to rate cuts. Pay attention to the 20-year yields as well. 20-year yields, you're looking at 4.7, the same area that's been challenging for us since last year. Okay, so pay special attention. The bears are trying to go, the yield bears are trying to go for this, which means your bond bulls are trying to get the upswing in the price right now and send us a bit higher on the TLT back into the low 90s. In my opinion, if the jobs report comes in either in line or slightly weaker than expected, that is going to be a big trade leading into the next 3, 4, 5 months into rate cuts. We've been accumulating, or I know you guys have been accumulating some of these bond trades. It is almost ready, in my opinion, just a few data points away from this trade probably starting to catch some legs and the longer term yields starting to catch up to some of the shorter term yield expectations as well. On to gold right now. Gold didn't have too bad of a day. It was down about 0.38%, still oscillating around the highs. Tough to play gold here either way, right? Very tough to short, very tough to long all the way up here. I'm a big fan of waiting for a possible pullback. If you pull back into some of these range resistance highs, call it like 34.30 type of thing, right? If you give me the good old breakout retest, then possibly I can play for some longs, but very tough. Gold really ran away from it. Congratulations if you are building some long swing trade positions into here. Your take profit areas is coming up very shortly, guys. 3,600 psychological probably is going to be it for you. The weekly bulls are in full control. You can also see the MACD on the weekly is crossing after being sideways for how long? Since the month of May. Starting to cross, bullish momentum, and the monthly leg of expansion is going for it. I was possibly hoping for a slide down into the 12, didn't give it to us. The monthly stays overbought, looking like NVIDIA a little bit. Gold apparently not done just yet at all. Very strong move, but tough for some short-term positioning. Either way, you really need to see a retest of some structure to get me a bit more interested in this one. Moving on to Bitcoin right now. Bitcoin a little bit soft today. Started off the morning really red and now kind of taking back some of those losses, but we know who's in control here. The daily bears are in control. Sure, we have a nice 786, 80% retracement size right now, but now we need to reset the daily uptrend to really end this weekly consolidation leg. It's been a weekly downtrend into where? A beautiful area of support, and I was telling everybody, right? Decent area for buying opportunities, especially just to nibble at some Bitcoin longs and or sell some puts under the market. The bulls reacting strongly from there. In the event we just continue our motion downwards, well, you know your weekly downtrend just continues into the support range. A lot of big bulls are probably sitting right there, 108 down to 100, and I'm sitting there too. And that at that extent, you just be looking for a bit more monthly consolidation coming down to the lower end of this, close to the 12, similar to what they've done a couple times over the last 2 years in this Bitcoin expansion cycle. Moving on to Ethereum right now. Ethereum down 3. The bulls, unfortunately, not able to get the clean break above. The daily bears are still in control of this chart. You get a break down below here, 4260. You're probably heading down below there. 4,000, 3,700 is the logical area of support. Weekly consolidation would just look all too obvious on this chart. Prior resistance, current support, as I said, 4K down to about 3,700. Looking for a weekly higher low on Ethereum. This would be another area to possibly build out some more swing trade longs, depending on your favorite product for Ethereum, whether it's SBET, whether it's BMNR, whether it's ETH A, ETH E, whatever you guys are trading, just always use the Ethereum chart as your guide, right? So that being said, that's everything for your crypto breakdowns. Now, let's get into big tech. So taking a look at Apple real quick, Apple up 0.55%, pushing into the 240 range. Looking very strong here. The bulls in absolute full control of this chart. Beautiful daily uptrend and breaking above our last line of defense in terms of resistance. This was a very problematic area for Apple a few times in the last year of trading, and now looking very, very solid. The bulls having a lot of space right now. Any pullback into resistance which is now going to be support. Anything above 226, looking for a new higher low for possible further trend continuation. And on the weekly looks very strong, I will admit. Beautiful weekly uptrend as of right now. Looking for a further leg of expansion. Your weekly higher lows are set 223. So any dips on Apple right now are indeed for selling put options into the mid 220 section. Not too bad at all. Congratulations for all you guys who are buying the dips with us all the way down here. This Apple trade is looking very strong. And shout out to Apple. They have the new iPhone 17 release date set for next week. Moving on to AMD right now. AMD down 0.21% during the day, but all in all, guys, not too bad. The Bulls are playing a lot of defense here at the 160, 157 range. 50-day moving average overall. Daily downtrend still towards the bears right now. In the event that Broadcom lifts you a little bit, you need to take out 170.43. Give me a nice engulfing move, reset this uptrend. We can officially say weekly consolidation is finished. And this entire time, we've literally just been looking for a new weekly higher low. And I've been a big firm proponent of buying some dips here. In the event it falls to the lower support range, 150 to 140, last area to accumulate. This is just monthly healthy consolidation, possibly looking for leg number 2 into late Q3, early Q4. We will see. Maybe they can do it sooner than that. In terms of the evaluation, I'll remind you guys, AMD still one of the cheaper names in the semiconductor landscape. So as a result, this lower 160 range, decent accumulation. Down here, decent second area of accumulation if you're not trying to predict these short-term timeframes all that much just yet. So not looking too bad on AMD. Moving on to Amazon right now, up 4.29%. And this was for a few key reasons today. Number one, you can see the headline right down here. Amazon secured its first airline client, JetBlue to be specific, for its satellite internet business, leading to a 4.3% increase in the stock price. That's very good. Some of you guys don't even know that Amazon has Project Kuiper. That's their mini Starlink, essentially. They're doing the same thing, exact same business model. A bunch of satellites in orbit, and now they're doing satellite internet businesses. So now their first contract with JetBlue, possibly looking to increase Wi-Fi speeds on a lot of airplanes. And if you guys travel frequently, you guys know the Wi-Fi speeds on airplanes, not too good, right? So maybe, you know, Jeff Bezos, right, who's trying to set up this business properly when he left the company about 4 years ago. Maybe that was a very good investment for them to start. Now Project Kuiper getting its first major contracts. But additionally, another piece of news right here was, can I find it real quick? I don't know if it was here as well. No, I guess I'll just tell you guys without having to pull up an article, right? It was their partnership with Anthropic. Their partnership with Anthropic, the revenues that Anthropic will be seeing. Amazon has a partnership, direct investment into Anthropic to be specific, to kind of use their Claude model. Which is a large language model as well. Revenues for Anthropic projections are extremely, extremely strong, which could possibly lead to a re-acceleration in AWS growth. Why is that important? Well, I'll remind you, the reason that people kind of scoffed at these Amazon earnings was because AWS growth was lower than Google and Microsoft's. Even though AWS is the largest player and the law of large numbers does not allow them to grow at 30-40%, similar to what Google and Microsoft are doing right now, still, the one point of contention of this earnings was AWS growth. So obviously, when you get some news headlines that something in AWS is contributing to faster growth, in this case, their partnership with Anthropic, well, of course, you're going to get another little bit of lift. Those two pieces of news were very good catalysts for Amazon stock today. I still keep saying every single video, Amazon is my favorite stock, possibly in the entire market right now. And there's a lot of other ones that are very close, but Amazon is my favorite because Amazon just has not gotten the same amount of love that the rest of the market has gotten so far. They're your laggard, guys. In the past 5 years, Amazon's only up 38%. The valuation of Amazon, even here when we ran it after earnings in the low 220s, is not that bad. Not that bad at all. Under a 2-peg, 35 forward price to earnings, and their margins are rising. And they're performing very well across all lines of business, right? AWS, cloud computing, advertising growth, and Amazon is just such a wide company, guys. This is going to be the first company that you guys will ever see print $1 trillion in revenue come 2029. And they do that through all of their various lines of businesses, right? Look, the projections for 2028, $952 billion It's absolutely ridiculous, and on improving margins as well. So watch out. Amazon's still one of my favorite names out there. Still a buy, in my humble opinion. Amazon is almost always a buy until really it becomes very overvalued, which it is not right now. But the short-term bulls are in control, right? We were paying attention here to see if they would cut this level, send us into a daily downtrend. No, the bulls played good defense here. 227 to 218 is your resistance range or support now. Looking for a new higher low for further trend continuation. So at this point, now that we're back above, any pullbacks into it, looking for some short puts down here, lower 220s. And for our leap calls that we have, still looking for the expansion of Amazon into 2027. I think this one is looking very, very good. Moving on to Google right now. Google up 0.68%, building upon their lead that they built yesterday after the news that the Department of Justice was obviously not making them divest Google Chrome. They can retain their partnership with Apple as well. They don't have to divest Android, but they do have to share some of their search data, not the advertising data, though. That's very important. So Google, I mean, the next stop for Google, guys, psychological 250. We're in a blue sky breakout right now. So as a result, who's in control? The bulls. Any pullback looking for a higher low, anything above 207, tons of space to set those higher lows. So I don't know if Google is going to stop here or just keep going. It's daily overbought on the RSI. If you want to know when the move is done, just pay attention to the 4-hour trend, right? If you lose the 4-hour trend, daily consolidation is underway. And at the end of the day, you're looking for a higher low. Even on the weekly, looking for a higher low. This is just crazy, crazy expansion from Google right now. Very happy to be a Google shareholder. Congratulations to everybody who is buying it back here. And at 225, is Google still cheap? Well, the multiples speak for themselves, guys. It is still one of the cheapest big tech names in the entire market, even here. So if you have a 5 to 10 year time horizon for your investments in Google, it's not a bad buy, not a full send buy, but still a DCA. I mean, it's a DCA up, but I mean, guys, the first time I bought Google, a lot of people have problems with DCAing up. There's no problem with DCA up as long as the company is still fairly valued, right? The first time that I bought Google was all the way back here in 2018 for my long-term portfolios as well, right? Almost every single one of my buys, because I put money in the market every single month, first week of the month, every single month, they've always been DCAs up. Sometimes through bear markets, they've been DCAs down, and through declines, we've got some DCAs from prior DCA events. But I mean, guys, if I were to just buy Google shares here and just sit on them and then just never want a DCA because they're all DCAs up, well, I wouldn't have the amount of share ownership that I have today, right? So as long as the prospects of the company are growing in the future, as long as the growth rates are good, as long as the valuation multiples make sense, I'm still a buyer. Moving on to Meta right now. Meta up 1.57%. Not a bad day for them. Recapturing one key level, right? This right now, they tried to go for the daily downtrend into an engulfing move right here. So now it's up to the bulls. Can they reverse into a new daily uptrend? We will see if they can get it done because Meta's been consolidating on the weekly right now for about the last 3-4 weeks in a row. The weekly bulls never lost this weekly uptrend. That has always been very favorable for them. So now possibly looking for another leg of expansion. We will see if they can get it done. Meta, still a fantastic company and not a bad buy here at about 750. If you come all the way back down to 700, I definitely will be adding a couple more shares. On to Microsoft right now. Microsoft up 0.52%. Microsoft bulls are trying their best to get a new daily uptrend going. You'd need a break of 510 to make that happen. We'll see if they can do it tomorrow. On the weekly, still weekly consolidation, pulling back perfectly into the 12. So we will see, can the bulls play good enough defense, get the new daily uptrend, get a weekly bounce underway here and perpetuate the daily uptrend or the weekly uptrend that they have not lost since the infamous April bottoms? We will see. One day at a time, of course. Not trying to predict this one right here. Is it a buy at 500? Well, the answer is no. See, Meta, even though Meta's close to the all-time highs, it is still somewhat of a buy. Google, even though it's all-time highs, it is still a buy. Amazon, same concept. But Microsoft, I got to draw the line somewhere, and the line is pretty much here. Probably top end of the valuation range. So compound annual growth rate might not be the best for any shares acquired up here, but still, I'm not selling any shares. I'm just holding. On to Netflix right now. Netflix up 2.55%. Beautiful daily uptrend expansion by the bulls. They've been playing defense down here for so long. Call it like a better part of the last month. 1210 down 1185, and now you finally get the clean break above. Daily uptrend reset to the bulls. Weekly uptrend looking good if they can close it like this tomorrow. And as a result, this weekly consolidation, right? Loss of the weekly uptrend, loss, consolidation. The whole time it's consolidating. That's a monthly consolidation level as well. When you get the weekly uptrend back like they're doing right now, monthly higher lows are set. Possibly looking for a new monthly leg of expansion. The next targets, of course, 1338. Fantastic push by Netflix. As of right now, at around 1250, the valuation is still a little bit high, not as high as Microsoft's, but still a little bit high. The only time I nibbled on Netflix shares was down here. I wanted the bigger buys to come down here. Doesn't matter if I don't get it. We were buying it on the channel together, right? Down here, all the way back here as well. So no problem at all. I have all the Netflix that I need. On to NVIDIA right now. NVIDIA up about 0.61%. We will see. Can they hold this area right here? 171 down to 165. Key area for NVIDIA to hold. This is the 50 daily EMA. They have not lost this since recapturing it during the month of May as well. They're under your short-term moving averages, but have not lost the longer dated moving averages as well. Daily downtrend, we will see. Do the bulls have it in them to give me a 7.8 retracement, 0.78, or maybe 0.618? Decent retracement size and change the trend? We will see one step at a time, right? As of right now, daily downtrend into still weekly consolidation into the 12 weekly EMA. On any red days on NVIDIA, fantastic area to be selling some put options under 160, right? All the way in this pocket down to 150. We'll see what happens on NVIDIA. As we said, their earnings were really good. I thought they were really good. And the valuation of NVIDIA, not too bad either. Moving on to Tesla right now. Tesla up about 1.33%. We will see. Can the bulls get it done and try this area of resistance for a fourth, fifth, sixth, seventh time, right? We'll see. Coming up into it right now, 340 up to 360. Keep that in mind. Interest rates going down is obviously going to favor Tesla and the entire auto industry, to be quite frank. And the weekly uptrend is still maintained right now. It's getting very tight. So the only swing trade on Tesla that I would want is a break and a retest. You got to give me the break of this one, or I'll just wait down here for support for a swing trade, or the good old breakout retest for a swing trade. As of right now, no positions on Tesla for me. Moving on to Palantir. Palantir up 0.8%. The bull is still playing a heck of a lot of defense down here. Very range bound though. Very muted price action from Palantir. Bit of a range, so you'll be looking for either one of two things. A break of 162, which gets your daily uptrend back, puts an end to weekly consolidation, and could send us back for another attempt at new all-time highs. Get a break to the downside though. Well, sadly, the daily downtrend continues. I mean, consolidation at the bottom end of a move like this, usually that's a bear flag and you are looking for more downside follow through. But if the markets keep pushing higher, Palantir is probably not going to get left behind. And conversely, if the markets unravel tomorrow, well, you will probably get a break, right? In all reality, you're looking for a break of either or levels. It's very tough to ascertain which way we should take positions here. If you're looking for a break of a range, right? You either want the breakout for a clean break and stop loss below here, or you want the breakdown for a short and clean stop loss above the highs, right? So keep that in mind for Palantir. The longer term bulls are still in control right now. It's still been a very nice weekly uptrend on this stock. Higher lows possibly set down here again, and below that, a 128.49. So the bull's still working with a lot of space. We will see which one this way breaks. You guys know the drill. Big red days for me. I'm looking to sell some options down here on Palantir. No other swing trades on this stock from myself. Moving on to SOFI right now. SOFI, surprising. Started off the morning very red, and then look at the big action from SOFI, guys. It was very red this morning. Huge push by SOFI into the end of the day. Very strong price action, if I have to say so myself. Reacting perfectly from our support range, 24.32 down to 22.30. So selling puts in this area, still a very decent proposition while it's still here. And building some more swing trade longs, right? Not too bad. The weekly bulls are still in control of this chart right now, looking for the good old back test and possibly the run. We'll see if they can actually get it completed if we consolidate a bit more. Still a nice area to be building some swing trades or some longs, mid 23s, and then save some buying power for the lower 20s as well, as both of those levels would just be looking for a bit of monthly consolidation. So that higher time frame consolidation, not too bad. In around 25 bucks, is SOFI still good? Yeah, still very good. Not as attractive as when we bought it down here, but still not the worst out there, especially when compared to other names that trade at 20, 30 times forward sales. Shout out to Robinhood. Moving on to Uber right now. Uber down about 1.03%. The bulls, a little bit weak here over the past couple of weeks of time. So very choppy price action on the daily time frames. We're trying to hold support 93.5 down about 90.5. But the short-term price action is very choppy. What makes the most sense is the weekly. Nice weekly uptrend, but the legs are getting more shallow and more shallow and more shallow. In the event you have a pullback right here, I'd be a big fan of playing this higher low pullback right then. Short puts under the market, low 80s. Why? Just based off the higher time frame trade, guys, looking for a monthly higher low, yeah? And the biggest area of support is clearly down there, 83 to 77. So although the daily doesn't present the most amount of clarity, the weekly is also somewhat dubious. The monthly, in my opinion, represents the most amount of clarity. If you do dip, it's going to be a great buying opportunity. And right now, it's not too bad in terms of forward valuation. Into the low 80s is when I really start getting a bit more attracted. And last but not least, TSM up 1.65%. Also just doing a whole lot of nothing since earnings, right? Very short-term choppy price action. Kind of range bound with a bearish leaning bias a little bit. That being said, the biggest area, guys, is the line in the sand from a couple Wednesdays ago, 223. No break of that. The daily downtrend does not continue. We're looking for the bulls to break 239 with a new daily uptrend and send us towards the highs and kind of confirm that, yeah, maybe 5-6 weeks of consolidation with a downward bias is possibly over into the 12 EMA a few times, and you might just be looking for another weekly leg higher. TSM even here, guys, for shares, it's very decent. I mean, at 230, the forward valuation, the multiples are still pretty cheap, especially with sold out demand all the way through 2026, right? Very cheap multiples, both on a price to earnings and on a forward peg basis ratio as well. So this, just very healthy weekly consolidation. Selling puts on big red days, still a big fan of, right? 220 down to 200 is going to be the target range for those. And all of this is just very healthy monthly consolidation as well for this phenomenal company. So everything on TSM, not looking too bad. Still a big fan of buying any and all dips on this beautiful company. That is everything for your overall market rundown. Now, let's take a look at some of the biggest gainers and losers of the day, shall we? So we'll do as many of these as we can in about the next 10 minutes. So Figma, we covered their earnings yesterday, guys. You guys know where I stand on this one. 45 is the buy area for me, only based off of valuation alone. So if that means that I have to sell some short puts under the market around 45, possibly going to do that. 45 down to 40. That's when the valuation becomes a bit more manageable in relation to the forward growth rates. If you want to pay attention to those earnings, they were in yesterday's video, so just go back to yesterday's video. I spent about 15 minutes breaking this company down and why I enjoyed in that location. But of course, these short-term bears are in full control. On to SMR right now. SMR, bit of a head and shoulders pattern, of course. It's pretty clear and obvious on the chart, right? Big head and shoulders. If you come back down here, 30 down to 27, not too bad. Looking for a monthly higher low into the monthly 12 EMA. Not a bad area for selling some short-term puts. If you are a fan of this stock, of course. Don't force yourself, only if you enjoy the stock and you want to buy it down there. Moving on to bullish right now. Bullish also with their earnings, which were not so bullish the other day. Unfortunately, we did not cover them on the channel, but this one is probably going to be a buy for me, relatively close to 40 or under 40. So I'll look for some short puts in the next coming weeks in the event that the bears continue their short-term control of this chart. We are not even daily oversold conditions. The earnings pop was just too large, but 4-hour oversold conditions are definitely present right now. If you get any more weakness with the weakness of overall crypto, because crypto has been a bit sideways recently, down to 40 bucks, not the worst trade in my opinion. On to DLO. DLO, actually a very interesting company overall. If I can find some short put opportunities down here, 12 to 11, they only have monthly contracts, but if I can find DLO, it's a bit of an X factor trade, right? Not the, it's okay. It's a fintech player. They serve some portions of the segment that other people cannot in terms of different countries and stuff like that. Not too bad. Their growth rates are pretty good overall. We haven't really analyzed them on the channel, but their margins are not too bad. I did this one with my Discord members. Not bad. Suffice to say, if I can find maybe like a 12 down to 11, wouldn't mind accumulating a bit of a lottery position, but it definitely would be a very heavy position for me. Names like ASTS continue to pull back. Big head and shoulders there as well. So if this one pulls back too, maybe the next area, the logical area would be like 35 down to 30. Keep in mind, this one's going to be competing with Amazon. Competing with Amazon is never fun. This is probably why the company was down this much today. So please keep that in mind. Down here, 34 to 30, if you want to play it, is the next logical area, as right now we are unwinding a few time frames, the weekly as well, and the big head and shoulders pattern. IRN, I know a lot of you guys like this one, and I like it too. We covered them after earnings just about a week ago at this time. Very bullish earnings. If you get a pullback, we'll just be looking for a very natural weekly higher low. If we can come back down like low 20s, you might find me farming some short puts like 20 down to like $18, $17. I wouldn't mind picking up some shares or being assigned down there. So that's the area. On any big red days of consolidation here after earnings, I'll be looking to just play the volatility and sell some puts down there. No reason to sell, in my opinion, if you have any shares either. The company is still looking quite attractive for the future. BMNR, I know you guys love this one, and I keep getting questions other than BMNR. Will, do you like SBET? Will, do you like the other ones? ETH-M? Will, do you like the... Okay. This is like the MSTR. This is like the MSTR argument all over again, right? Why do I like BMNR more than the other ones? Because it has the most amount of institutional interest. What Tom Lee is trying to go for here is he's trying to accumulate 5% of the entire supply of Ethereum. He has direct, well, not Tom Lee, but Peter Thiel, who's invested in this company as well. If you guys don't know, Peter Thiel is literally the person that funded Vitalik Buterin when Vitalik was creating Ethereum. The links are very clear here. And Tom Lee goes on CNBC and shills the heck out of this ticker almost every single other week. So why would I be playing the other companies that don't get enough attention, right? Sure, maybe the other companies are more undervalued on an MNAV basis, and that might be true. But this one will be the one that has the most amount of attention. And we know in the crypto space, because at the end of the day, these are crypto tickers, attention is the main currency. As a result, my go-to play will always be BMNR. And as a result, I will continuously sell short put options, possibly down to the mid-30s at this point. Market cap is not too bad. They're continuously getting new investments. They have the largest institutional profiles out there, the most amount of money coming in. They will raise the most amount of capital. As a result, this is the fastest horse in the race, in my opinion. Moving on to other names, such as CRM was down after earnings. You guys know my stance on that one. If you don't, just go back to yesterday's earnings, and I gave a full rundown of why this one has so many problems, why it could be a decent bet down here, but why you also could not be expecting much of a fast recovery. It could be a very slow and methodical recovery of some of the SaaS players, but maybe not the fastest horse in the race for that one right now. And even the valuation, right? This one's trading at a similar valuation as like an AMD for like half the growth rate. So, you know, I know it's not the same industry, but I'm just saying CRM is not the best play in the market right now, at least not in my humble opinion. BITX is my go-to vehicle for selling puts under the market on Bitcoin. Mid 40s is what we're looking for here. I'll probably be selling another short put next week for 45. 45 on BITX would be synonymous with a pullback into Bitcoin here, 103. It's been on my top 5 options list, guys, for like the past 3 weeks. Every single week. It'll probably make the list again this upcoming Sunday when I film it from abroad. Other than that, I mean, there's other things we could talk about. BYDDY, I will be adding to my long-term position in this one. Down here, 13 down to about 11 bucks. Not too bad at all. Probably my favorite Chinese IV maker. I know a lot of retail is just clamoring around the NEO trade, and that's fine, right? That's fine, provided that you understand it's a bit of a lottery trade, right? BYD, in my opinion, the better business model, the better company, the company with the most amount of scale and the most amount of profitability, which is an important metric. Beautiful breakout retest here on the monthly chart. So I will be adding some more shares to BYD right there. I think that's pretty much it. The ones that we haven't talked about recently. I mean, we can talk about CoreWeave. CoreWeave for me is still a buy, but you guys know that just based on a longer term thesis, expansion 2027, 2028. Short-term sentiment eventually will go away, right? Insider selling, yada, 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 debt, all that stuff, right? Insider selling narrative is going to go away probably rapidly. And the debt narrative is probably going to go away quite rapidly as well when people realize like, hey, most of their debt is for 2028, 2029, and the short-term debt that is due 26 and 2027, that can be refinanced at lower rates because the Fed's bringing down interest rates and they're scaling extremely quickly. Some of their main partners, Jane Street and NVIDIA directly. So again, a nice area to be accumulating, but it's going to be a very bumpy trade. I've said this many times in the past. I'm not going to try and call out bottoms here. This is an accumulation trade for a longer term thesis. If you're trying to play the short term on this one and not waiting for daily uptrends, you will get chopped up continuously trying to pick the absolute bottom on this one. Other than that, I think we did a good job of covering most of the names that were mostly down today. Open Door, this still remains a lottery trade from me. I've had the same stance since we positioned in this one all the way down here. It is a lottery trade. Play this one with as much money as you're willing to lose. Yes, the upside can be significant, 10, 12, 15, depending how high we push it. I mean, the business, it has a theme, right? Rate cuts obviously will play into the business model. They're still kind of bad at buying and selling homes for a profit. They're better at it nowadays than they were back here. But at the end of the day, it is still a lottery trade, guys, right? It's not a very high quality company, but the short squeeze is very apparent right now, and it can still keep going. So this one is a hold for me. HIMS recovering quite nicely, trying to test our resistance range right now, 52 down about 48. Daily uptrend recaptured by the bulls. So we will see. Maybe that's the end of weekly consolidation. The one thing you would want to see, though, is a recapture of the resistance range overall. We will see if they can get it done. HIMS, we did the valuation at 40 bucks. It wasn't too bad on a forward price to sales metric. So down there, it wasn't a bad opportunity to be adding some shares. And even here, it's not the worst proposition either. Short term, it's going to be very bumpy and very choppy. But if your thesis is to hold 2028 and 2029, you can see an expansion of the market cap quite decently, as a matter of fact, right? The forward guidance for 2030 at between a 5-10 multiple on price to sales is 30 to 60 billion. The company's only trading for about 11 right now. So you probably have some decent upside, provided that you can withstand the volatility. Short-term trading, a little bit tricky on this one. Rocket Mortgage, one of my favorite companies into 2026. all dips in my opinion are for buying. If you get another dip back down here, once again, short puts and maybe accumulating some shares. Very strong thematic play for the rate cuts, of course. In terms of Restoration Hardware, this one as well, thematic play, right? Not going all in, but I do have a couple shares just for the theme, consumer financing themes, of course. Furniture is a big portion of that. And Restoration Hardware, just in January, was at 450. So I'm looking for a recapture here. You guys know I've been holding some shares with a 220 cost basis. So we're just now kind of breaking above water. Not too heavy, just another one of my thematic plays that you can kind of add to the list. Very nice support area. Not going all in at all, that being said. A-Lab, we can take a look at A-Lab. A-Lab is very expensive up here, guys. There's just no way to cut it. It's very expensive. It's incredibly tough to start a position long up here. I know it looks good, but it's just not my style to buy things when they're this extended on the weekly, this extended on the monthly timeframes. If we're in from down here, there's no reason to sell because the company is executing very well, but extremely tough to get behind the company's valuation and or short-term price action at this point in time. If anything, you got to trade it with a stop loss. 167 stop loss, going for the expansion here, probably 200 psychological first take profit, but the risk reward is not the best on that. You'd be looking for it to push like 220 for that to actually make sense. Affirm, I kept saying Affirm, guys, after earnings, phenomenal company, but also one that you have to position in for the theme, consumer discretionary recovery, which is a like 6, 9, 12, 18-month theme, right? The short-term price action is going to be bumpy, but we did them after earnings, guys, at around $90. It's not that bad. Price to sales is not that bad. The PEG ratio is not that bad. You would be surprised at the numbers that Affirm can probably pull out of the hat coming into the next few years. Fantastic earnings. If you haven't seen my earnings breakdown, we did it about 2 weeks ago at this point on the channel. Micron, one of my favorite semiconductor companies in the business. I keep saying it's been on the top 5 options plays now for a while, guys. I keep saying when we come down to close to 110, it's a buying opportunity, whether with shares or selling puts under the market into the support zone. Not a bad opportunity. And at these valuations, not a bad candidate for leaps. The reason why you guys are not seeing me open leaps is because I bought them down here. So now I'm just riding what I have. Matter of fact, I'm already out of 40% of my position. I had 10 of those contracts in my big account down here. My Discord members are aware of that as well. In the public trading account, I still have that one leap call contract, which is up like 140% right now. Micron still looking very strong for expansion 2026, 2027 as well. We're not really too late right now, but you know, you got to take advantage of these dip opportunities when they give them to you. And I think that's pretty much it. Special shout out to like Oscar Health as well. Oscar Health, we did a good job of building some small leap call contracts back here. We're currently up about 40% on those calls right now. Any dips on Oscar, in my opinion, are still for selling puts under the market. We covered that one on the top 5 options plays on Sunday. There's still a bit of a room to run here on Oscar Health. We're targeting like the top end of the 20s right now for the expansion of the healthcare insurance trade. I like this one for the simple fact that it's the fastest horse in the race. It's easier to rally a $4 billion market cap than it is to rally a market cap like UNH or the other ones in that niche for that matter, which is why it's still my favorite play. So any dips, decent opportunities to possibly accumulate and maybe ride. And I think that's pretty much it, guys. We're going to kind of put an end to it there because if not, I'm going to go through this entire list. And that's not the point, right? The point is just for you guys to understand how I look at these charts, and maybe you can look at other ones on your own. So that's everything I had for you guys today. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday through Friday, except for tomorrow, because tomorrow I am gone, going to be on a plane. Last video of the week for me, but I will see you guys on the Sunday session for the top 5 options. And last but not least, if you have any questions, please feel free to leave them down below. I'll do my best to answer them over the next few days. And that's pretty much it for me. You guys know the drill as well for the Discord. In the event that you guys wanted to join a community of like-minded investors and traders such as yourself, over 200 members in there. We have a lot of fun trading the markets, talking in there every single day. It's a fantastic community, and maybe you might like to be a part of that as well. In the community, you get access to all of my trades, which include, but are not limited to, the wheel trades, all the leap call option trades as well, the short-term directional trades, any lottery trades that I might take. So many different options trading strategies that I do in the channel. I'll give you guys the portfolio rundown probably next Monday. Today, we took some pretty nice trades, so you guys are going to have to wait. It took some new leap call options. The Discord members know what we're in. You guys might find out on the Monday session, but if you're in the Discord, you guys know exactly what we did today. Very excited about those new positions. Here are all the trades that we've had over the past few months. The green little check marks are wins. The red little circles are losses, of course. You get access to all of those. You get access to our private morning live streams where every morning I trade live and take all your questions on your stocks, your options, and your long-term portfolios. It's a fantastic area to interact with me directly. If ever you wanted me to review some charts, review your positions, review any trade types or whatever, or educational things, it's a lot easier for me to do during live streams when I can go through the charts, go through the financial statements, and really teach you guys everything that I possibly can. If you can't be there, they're recorded, and you can also ask me all your questions in our chat rooms. You get access to our educational section as well, where there's videos there about technical analysis, fundamental analysis, all the options trading strategies that I use, right? That a lot of you guys ask me questions about in the comments, but I can't give you guys in-depth explanations. There's like hours of videos on call debit spreads, leaps, all that stuff, how to grow small, medium, large portfolios, which proportion of those portfolios should be in which trading strategies, how to build long-term portfolios as well. Got an hour-long video on that too. Very nice educational section there. And last but not least, you get access to all of my watch lists and all of my charts whenever you guys see, support resistance areas on some charts. If you want to just copy them, copy the earnings breakdowns and all my watch lists, you can do that with 2 clicks of a button. It takes like 15 seconds and they all become yours. Just an added benefit to our Discord members. If any of that sounds good to you, the link to join our community and participate with us in everything we do is down below in the description. Hopefully I see a few more of you in there soon. And if not, I'll see you right back here on the channel. That's it for me. Take care. Have a good day tomorrow. See you over the weekend. Take care again and peace.